Hi, my name is Udit and I work in Germany as a finance manager. In today's video, we are going to talk about how to navigate bear markets. Technically speaking, bear markets are period where we see a 20% decline in prices from the top. If we talk in context of the Indian stock market, the Nifty is approximately 11.5% down from the top that it made around September end. And you see a lot of panic is spread in the market because the mid cap and the small cap index has fallen much higher than the large cap index. You have seen some individual popular stocks which were the flavor of the day some months back are down by 20 to 30% from their top. What has led to this decline? The reason is the euphoria that was built in the prices, and the earnings were not able to justify those high prices. About this, I have already spoken about in my previous video on Nvidia versus DeepSeek. What happened was around 7 to 8 months back, there was an over exuberance in the Indian stock market and the stocks were priced to perfection. There was nothing that could go wrong that was priced in the valuations of the stock. What happened was in the quarter following that period, the earnings of major corporations it slowed down. When the earnings slowdown happened, the pricing, the valuations of those stocks which were priced assuming high growth, which had a very high growth priced in, these stocks fell down because the earnings were not justifying the valuations, and this led to a domino effect. Couple this with the global turbulences, especially the US elections and the aftermath of it, which were the subsequent announcement that the president is making, that led to a shakedown in the overall market and the sentiment reversed. And this has led to a panic with the investors. Now you see all the experts who come up with the data on a day-to-day basis that how much the foreign institutional investors have sold during the day, how much the domestic institutional investors have bought, how much the retail has bought or sold during the day. Let me tell you, if you are a long-term investor, all these statistics are of no value. Because if your original investment hypothesis is intact regarding a stock or a sector, then you should not worry about these fluctuations because these are an intrinsic part of the market. These are the intrinsic part of our investment journey. So, what should you look at? You should look at the performance of your companies, the companies that you have invested in. Has anything changed in the fundamentals of those company? Has anything changed in the business or operations of these companies? If the answer is no, then you should stay put. Just be patient. It is just a slowdown. It is just a temporary phase that is going to go away. Let me also tell you why these FII selling and DII selling should not be a major concern to us. The foreign institutional investors, as we call them in the market parlance, are large pool of global portfolio managers who have a specific allocation to different countries. For example, they might have 1% allocation to India and 65% allocation to the US stocks. Maybe with the election results and the developments in the US, they foresee that they should increase their US component in the overall investment portfolio by 0.2%. What they would do is that they would sell off 0.2% of the India component because this seems expensive to them and buy US at that point of time. And they keep on rotating this money on the basis of the macro factors because their outlook is mixed. Sometimes they have a short term outlook, sometimes they have a medium term outlook, and sometimes they have a long term outlook on a certain section of their portfolio. But you, as a long term investor, should not be bothered if a fund sitting in New York is offloading its 0.2% share in India to buy US equities. Does it impact your investment hypothesis? The answer is no. If you are a short-term investor or trader, then you have your charts and your patterns and your RSIs and moving averages at your service. can make use of them. I don't use them personally, so I can't say for that. And also, I don't have a short term outlook towards my portfolio. What I can talk about is the mindset for long term investing that we need to cultivate. It is said that bear markets should be treated as our friends because the money is actually made while we are making investments in a bear market. What happens is that when the prices go up in a bull market, these gains are actually realized. So, the actual buying and waiting is an intrinsic part of our stock market journey, which happens in the bear market. So, we should be patient, we should do the right things, we should keep on investing in the right businesses at the right valuations and wait for the good times to come. This is how we should approach problems and difficult situations in life too. Whenever we are going through a tough time, let's take a step back, let's zoom out, let's see where we are and where we want to be. Be patient, continue doing the right things, take action, and then be prepared for the good time. Because when the good times come, and they will definitely, and if you are prepared on the basis of the patience and the actions that you have taken in the bear market phase of life, this is going to pay very high dividends in the long run. So, my friends, the message is loud and clear. If the time is tough, then just buy right, sit tight, be patient, and wait for the right time to come. And just remember this phase both in good and bad times. This too shall pass. Thank you.